Bismillah ar-Rahman ar-Rahim. So far in the previous sessions, we explained some ratios related to the profitability, related to the liquidity, and related to the efficiency or business efficiency. Now, or today, I'm going to talk about the market value ratios. This market value ratios is much related to the investor decision. So investors, when they are looking or they want to decide to invest in a particular company, they are directly look at these ratios. These ratios includes the price earning ratio and market to book value ratio. Okay, so these two ratios answer the question: it is worth to invest in this company or not? This is the main question addressed by these two ratios. The price earning ratios generally known by investors like BE ratio. So BE ratio is the price divided by EBS. So the price is the market value or the market price of the stock, and EBS is earning per share. The EBS can be calculated by the net income divided by the number of shares outstanding. Now, what it means? What it means, BE ratio. In order to know what it means, take this example here. The BE ratio for company A and company B. For instance, company A, the BE ratio is 10, and company B, the BE ratio is 13. So anyone can explain what it means, 10 or 13? Okay, which you prefer, 10 or 13? Which you prefer? Company with A with 10 BE ratio or with 13 BE ratio? 13. Okay, let's hear you say 13. Why 13?
Investors are willing to pay 13 for $1 earning per share.
So the investors are willing to pay $13 to get $1 profit. So what do you think? This is what you said. So it's better to pay $10 to get $1 profit. I'm talking about the investors. And even the company, the companies are not interested in B. They are not interested because they want their prices to be marketable. So the investor here, look at here, what it means, the BE ratio. The BE ratio, it means to get $1 profit, you have to pay $10. To get $1 profit, $1 EBS. EBS is a stand for the net income divided by the number of shares. To get $1 EBS, you have to pay $10. You have to pay $10. You have to pay. But in company B, this is for company A. For company B, to get $1 profit or EBS, you have to pay $13. Which stock holding higher cost? A or B? B. So the investors only pay $10 to get $1 profits, but here they pay $13 to get $1 profits. So be careful in this. And this here, A is more efficient than B in generating profits, because just only I bought $10 to get $1 profits, but here I paid $13 to get the $1 profit. Okay, this is the idea of the BE ratio. Any question related to this one? Okay. Let's see the market to book value. The market to book value. What it means, the market value of the particular share. What is the market value of a particular share? What is the market value? The value at the stock market, yes?
The price of the share that traded in the financial
In the financial market, yes. The price of a particular share that's traded in the financial market, yes. Yeah, another definition of market value. Another definition. It is the price in the financial markets, okay, or the current price in the financial markets. Okay, so this is for the market value. Now I'm try to compare between the market value and the book value. Now we know the market value. What is the book value? Okay, let's see the book value. What is the book value? Okay.
The price of the share.
The price of the share.
Or the value of first issue. Or the value of the share.
Okay.
First issue.
I'm not agreeing with you too much. Yes. What is the book value? Sometimes we call this book value, but now comparing with the market value, it is not the direct answer for the book value. What is the book value? From the accounting perspective.
Historical cost.
Historical cost. It could be. Carry on. Say anything. What is the book value? What it means, book? Yes. Where is it? It is in the box. The value of, you are talking about depreciation now, no. The book value, it means, anyone knows? No? Yes?
The value of the assets when I pay cost to acquire this asset.
The value of assets.
When I pay cost to acquire this asset.
Let's see, put it in different ways. We can define the book value is what is left after paying back the liabilities. Did you understand? What is left after paying back the total liabilities? So what is left then? What is the residual after paying back the liabilities? Just conceptualize this in your mind. What is left after paying back the total liabilities? What is left? Equity. Yes, it is equity. So the book value is the equity then. Yes, the book value is the value of equity in the accounting books. Okay, so the book value, according to our definition, to the is what left after paying back the liabilities. Now look at this T account. This is the T account. Here we have, as we said, this is current assets and here fixed assets. And here is the total asset. Here is the current liabilities and here is long-term liabilities. Okay, so this is total liabilities. Okay, and here is equity. Now, according to our definition, the book value is what left after paying the total liabilities. So after paying the total liabilities, what is left? The equity. Okay, so the equity here considered as the book value. So this is the total book value. But the problem in the book value, it includes the common stocks and the preferred stocks. Common and preferred stocks. So if I want the book value of the common stock, if I'm talking about the book value of the common stocks, so we only deduct the book value minus the preferred stocks. So we end up with the book value of the common stocks. In other words, by using equations, so the book value is equal the assets minus liabilities. because this is the assets minus this, we end up with this. So we have the book value. But this is book value is the total book value. If I want to know the book value fee for each share or for for each stock, so the book value divided by the number of shares outstanding. Okay? The book value per share, but generally because the book value is defined related to each stock. So the book value for each stock is equal the total book value, which is in here, divided by the number of shares outstanding. Okay? So the book value is in here is like equity divided by the number of shares. If we don't have preferred stocks. If we have preferred stocks, you have to deduct preferred stocks from the equity. So you have different ways to think how to estimate or how to calculate the book value. You can do it like this. So they just remove the total assets, remove the total liabilities, and you have the equity. Divide the equity on the number of shares outstanding. You have the book value. Or you can use this equation by book value is the total asset, minus the total liabilities. You have this. This is the rest in the balance sheets. Now, and this is just to introduce yourself how to estimate the book value. Now, we want to make the relationship between the market to book value. This is what we want. We talk about the book ratio, and we talk about the book value, or the book ratio, and the market value. Now, let's put them together, the market value and the book value. So the market to book value is the market value divided by the book value. So this is the ratio of we know the market value is the price in the financial markets, and we know the book value is the assets minus liabilities. Minus liabilities. So we know everything now. Now, what it means, market value to book value. Let's take an example of what it means, the market to book value ratio. Any question? No? It's fine. Any question before going in details? Okay, so what it means, the market to book value. Let's see example here. If the market value is 4 or 5, let's see, 6 here, or the book value is 2. The book value of 2 and the market value is 6 here. Now, ask yourself, market value is the traded price in the financial markets. So it means if I want to buy the share or to sell the share in the financial market, it's traded in the $6. But if I want to liquidate the company, the rest is just only $2. So there is a difference between the market price and the value of the business in the book. Now, the ratio is divided, market to book value is 6 divided by 2. So it's a 3. From financial perspective, if the market value exceeded the book value, it is fine. This is indicate a healthy situation for the business. So if the result is greater than 1, it indicates that the market value is greater than the book value. And it indicates that the price of this company is growing up. Because in the book is 2, and in the market is traded by 6. So there is a trade on this company. So why it is 6? Because it's growing. it was, let's see, if we define the book value as a historical value, as some students saying, so for instance, it's starting by 2. So it's growing up to 6. So it indicates that this price or this company is growing up. If we compare, for instance, company A with company B, company A has 3 and company B, for instance, 5, it indicates that company B is growing up faster than company A, which indicates that company B is much better than company A. Okay? Now, but the problem is, maybe the market to book value, this is not in your textbook, but this is just to bear your mind. Sometimes it is not healthy to have a higher market to book value because it indicates for something known as a bubble. Bubble. What it means. Look at this example here. If the book value is $2 and the market value is growing up faster and faster till, for instance, $15 or till 15. So the book or the market to book value is 15. It means the market is covered the book value 15 times. Okay? And you see it is growing up very fast. And this may generate the bubbles. If you want to liquidate the business is $2. But in the market is $15 or 15 times priced over the original price. I mean the price on the book. And this is maybe is overpriced. Overpriced. The price in the book is 2 and the price in the market is 15 times the price in the book, which is maybe not real. Maybe the traders make this. Let's see the financial bubbles. The financial bubbles hit the United States and some European countries because it was increases in the housing price. So what's happened in the houses price? Consider this house, okay? This house is worth around $100,000. Okay? And this is the book value of this house, how it's worth now. And the traders trade on this house and make the price to be $400,000. Do you think this price is real? What is exactly going? I am the owner of this house, then I sell it to this trader to the second one to the third. So this is a trade from one investor to another store, and then it's make bubble. It's like make bubble, فقاعات. Bubble معناها فقاعات. Why they call this bubble? Because it's easily you can hit these bubbles. You can easily damage them. يعني بسهولة ممكن لو نفخنا على هدول يرجع السعر ل 100,000. وهذا اللي بيصير في اليونايتد ستيتس وفي الولايات المتحدة. ممكن below the 100,000. فالناس اللي اشتروا الهاوس, for instance, some people buying the house in here at 150,000. So when it goes 400,000, it goes for another one. So when it go back to the origin price, they lose their money. يعني مثلا بالعربي نحكي لكم اياها. اللي بصير انه احنا نشتري بيت $100,000. طيب بعد ما نشتري البيت هذا بصير واحد يبيعه للثاني يستثمروا فيه. باعوا للثاني هذا 100 باعوا للثاني 150 200 300 400 لما صار هل لقيتنا نفترض اجى واحد اشتراه عند ال 400. هل السؤال هل هذا سعره الحقيقي؟ هذا كله بابل، هذا فقاعات، يعني حكي هيك على الفاضي. يعني انا اجيت اتفقت انتم هنا مثلا مستثمرين، قلت لكم هاي البيت ايش رايكم بدنا نرفع سعره لفوق؟ انا بشتري ببيعك اياه وبتبيعيه لجنبك وكذا كذا، بصير الاسعار ايش؟ ترتفع. الاسعار ارتفعت مش بسبب العرض والطلب، خد بالك، مش سبب العرض والطلب، سبب انه الانفستورز نفسهم هم تو ميك ذس، هم اللي عملوا الكلام هذا. فصار 100 110 150 100. لما اجى واحد مسكين تقول لك الاسعار والله اسعار السيارات ولا اسعار البيوت قاعده بترتفع، خلينا نروح نشتري، نستثمر. فراح هو ايش؟ استثمر على 400. راح مسكين اخذ مورتجيج، عشان نيجي نحكي للمورتجيج، اخذ مورتجيج يعني اخذ قرض عقاري واشتراه على 400. هذا صار بال 2008 تقريبا عند الامريكان. ايه؟ بالازمه الماليه راح اشتراه على ال 2008 وراح دفع واخذ قرض، اخبط اللي هو السعر نزل ل 100,000. فهو مسكين قاعد بيسدد قديش؟ في ال 400. ولو بده يبيعه ب 100 يا دوب يسدد الفوائد. فهذه بابلز، هذه اسمها فاينانشال بابلز. فمعنى الكلام مش دائما بيكون الماركت فاليو is reflecting the healthy situation of the business, because sometimes it indicates for bubbles، يعني بيعكس البابلز اللي بالفاينانشال ماركتس. طبعا انا حكيت لكم الكلام هذا عشان تشوفوا ايش بيصير ممكن في الانفستمنتس. But generally for your level the market value should exceed the book value. Okay? And this is reflect the healthy situation of the business. Any question for the market to book value? Is it clear now? Okay. Okay, this is how they calculate this, and I give you this is the checkpoints. In this checkpoint, comparing the valuation of Dell, this is producing computers and hardware, to Apple using market value ratios. So you have the net income, you have shares outstanding, the number of shares outstanding, earning per share, price per share, book value of the common equity, and book value per share. So what is the market value here? What is the market value in this? What is the market value? What is it? The price per share. Yes, it is 15 for Dell and 241 for Apple. Okay? What is the book value? $2 for Dell and $34 for Apple. What is the market to book value? Calculate the market to book value. Yes, do it. Do it. Calculate this. So try to calculate the PE, then calculate the market to book value. Do these two. The PE is the price divided by the earning per share. So you have to calculate first the earning per share, which is the net income divided by the number of shares outstanding. Yeah, very simple, do it. يلا. Do it. بدنا نحسب البي اي ونحسب الام الماركت تو بوك فاليو. اللي عارفين البي اي البرايس على الايرنينج بير شير، على الايرنينج بير شير، والام بي اللي هو ماركت تو بوك فاليو. البي اي الاي بي اس النت انكم على النمبر اوف شيرز اوتستاندينج، فهي نت انكم وهي شيرز اوتستاندينج. يلا نشوف.
Okay, the first one is 21.3.
The first one is 21.3. This one.
The second one is 5.40.
5.40. How you calculate this?
We see the price.
Price.
By net income divided
Price divided by the net income.
price divided by
EBS.
Yes, EBS.
Okay, so you first net income divided the number of shares, you have the results, then
Yes.
okay. Okay. So the answer is 21.30. Okay, see the results. So 21.3 and the market to book value is 5.41. So what do you think about this result? All the students get this number? All of them? Sorry? Let's be انت ايش المشكله وين؟ شو ايش؟ بدنا نحسب اول شيء نحسب اللي هو البرايس على كل ايش؟ عارف البرايس ولا مش عارفه؟ وين قديش؟ وين؟ برايس بير شير اوكي 15 تمام اوكي طيب على الاي بي اس ايش الاي بي اس؟ evening per share. طب ايش بتساوي evening per share؟ شرحنا. بس لو شرحناها evening per share. evening per share هي net income على number of shares outstanding. مظبوط ولا لا؟ ايش البنات اللي غاد؟ غير
12 5 و4.
طيب نحلها مع بعض ها. طيب نيجي للبرايس earning per share. ايش بتساوي؟ What is the price? The price is 15.56 divided by the EBS. The EBS net income is 1433 divided by 1962. Just get the results. Okay, the second one, market to book value. The market to book value, the price is 15.56 divided by the book value. The book value per share is 2.88. So that's it. Okay? هذه اسمها ABS. القانون ايش بقول؟ البرايس على الايرنينج بير شير بتساوي هذه نفسها هذه بتطلع هي نفسها. اوكي بس انا عشان in case you don't have this اوكي او ممكن هيك دايركت هي do this 0.73 هذه صح وهذه صح. ممكن ما يكونش معطينا الاي بي اس فبدك تطلعيها. اوكي So as you observe here, the price. So which you prefer, Dell or Apple in terms of the price to earning per share? Dell, because you pay less to take $1 profits. For the market to book value, it is 5.41, 6.91. It grow faster, and maybe Apple is subject for financial problems. Okay, so this is the thing. Okay, now let's do summing up the financial ratios. And when we are discussing the financial ratios for the Baswell company, we think that the liquidity is fine. Okay, كملي. عيدي سؤالك. خلينا نسمع يا بنات. البوك فاليو. عيدي سؤالك. book value. Two definitions. Common equity. Okay. I think you get confused from what things book value and bar value. No. No. The bar value is the value of the stock when it is issued in the markets. This is a bar value. But the book value, it includes, if I want to go in details, the book value includes the value of the common stocks, the retained earnings, and any account related to the common stock. So the paid in capital, for instance. Again, is the value of the common stock or the common equity plus the retained earnings plus the paid in capital. This is the book value for common stock. There is a book value for equity. It includes the preferred stocks because we are talking about the total equity. If we want to know the book value per share, just divided the book value divided by the number of shares outstanding. Okay? So again, the book value is what is left after paying the liabilities. Now, we're summing up the financial situation of Baswell. We observe that the liquidity is fine, but the problem, they face some challenges in inventory. So we should try to think how we can improve the liquidity. And financial leverage, we observe that Baswell, they use more debt comparing with the industry. So it is recommended that to reduce or to pay back the liabilities. In terms of profitability, the efficiency of this company to generate profit, it's fine. And the problem is, they have problems in paying back the interest expense because they hold higher debts. So this is influence on their profitability ratios. So we should think on how we recover the debts in order to improve the profitability ratios. For the market value ratios, it's fine, but again, it could be subject for the bubbles. These ratios suggest that the market is pleased with the firm as indicated by higher stock valuations. So it's fine. The PE ratio is fine, and the market to book value is fine. Now, the last thing in this chapter, we will talk about the selecting performance benchmark. Now, after finishing the analysis of the financial statements, how we can judge on these ratios? We can use the trend analysis. What it means, the trend analysis, it's evaluate the business performance over time. For instance, we evaluate the business with the previous years. Or we can evaluate the business with other companies based on the time. So this is the trend analysis. The peer group comparisons, we can compare our business with the industry level or with the competitors or with the peer group. This is the thing. For instance, if we talk about the trend analysis, this is the time and this is the performance. You compare yourself with the historical price. If you talk about the peer group, you can compare yourself with other groups or with the industry. For instance, we can compare Google with Yahoo, for instance, like this. So compare this blue line with the black one. So this is Google, and this is Yahoo. So comparing yourself with the peer group or with the industry level. So this is example of for the gap with the industry level or with the industry average. And you know gap producing close. So if you look at, just pick up the price earning ratio, 14 and here 15, it's close to the industry average, but still is less than the market to book value. The industry is higher than the, if we look at the debt ratio, the industry using up debts more than the gap. If you look at the current ratio, the liquidity for the gap is much better than the liquidity of the industry average. As you observe, there is some strong buoyance and some weaknesses buoyance. If you look at the inventory turnover ratio, it's around 5, and here 4.30. So it means the liquidity in gap is much better than the liquidity in the industry average. So this is the way how you are comparing yourself with other businesses. However, we cannot 100% rely on the ratio analysis, and we will talk about the limitation of ratio analysis. And these problems includes picking an industry benchmark can sometimes be difficult. Sometimes it's hard to pick up the industry average. Why? Because if you compare yourself with some companies, maybe these companies working in different areas and working in different countries. So they are subject for a particular issues and particular problems which is you are not subject of them. So the idea of benchmark sometimes is difficult to compare yourself. For instance, if we compare the Mercedes-Benz car with Mitsubishi. So this company producing car and this company producing car. But the problem is Mitsubishi hold more than 100 companies. So how you compare Mercedes with one production line with Mitsubishi with 100 production lines? So it is unfair to compare this company with this company. Okay, another example. If you want to compare Mercedes with Volkswagen, Mercedes company is holding one line to produce Mercedes cars in different versions. However, the Volkswagen, it includes 5 companies: Volkswagen, Skoda, the Audi, and other companies. So this is the idea. Sometimes it is unfair to compare yourself with other companies because other companies, they have their own situations. Number 2, published peer group or industry averages are not always representative of the firm being analyzed. Sometimes, because these companies working in different areas, so it is unfair to compare yourself with the peer group. An industry average is not necessarily a desirable target or norm. Sometimes the industry is not reflecting the accurate or not reflecting the promise of the company because the industry is influenced by the economic factors. For instance, if we talk about the recession period of time, the industrial average is going down. So you are comparing yourself with the market going down. So it is not reflecting the desirable action for a particular business when all of the industry average is going down. The accounting principles may differ from company to another. This company using LIFO and this company using FIFO. This company using straight line methods and this company using diminishing methods. This company paying out dividends, this company not paying out dividends. This company retain earnings, retain their earnings, this company paying out the dividends. They have different policies, they have different procedures, so it is unfair to compare between companies who pay dividends and companies who pay or keep the profits. Many firms experience seasonal changes in their operations. Some companies, their cycle is like this, and other companies are in the opposite of this. So this company, let's see if we observe, this is the Chinese company. And we are sitting in here. Now we are in 2013, so we are located in here. And if we compare this with Japanese companies, or let's say the German companies or European companies, they are here. Because this is season. So how come you compare this company with this company? Maybe tomorrow or the next 10 years, the situation is different. So this is the economic cycle. So it depends on the season that the business work, or depends on the economic cycle. Number 6, financial ratios offer only clues we need to analyze the numbers in order to fully understand the ratios. Sometimes you have to read behind the figures. Figures is not giving you the accurate answer of the real financial situation of the business. Because the financial ratios is static ratios. So you need to, for instance, when you talk about the price, the PE ratio, or let's see market to book value, look at the market to book value here. The market here is a change every day or every second. But the book value is static. It's just calculated every 1 year or at the end of the year. So it doesn't give you that, let's say, a dynamic figures reflecting the accurate situation of the business, because this is calculated every year. But this is, yes, this is every second or every year, but it does not reflect the dynamic situation of the business. Number 7, the results of financial analysis are dependent on the quality of the financial statements. So if we produce a high quality financial statement, we have a good financial ratios. And this is depend on the accounting principles, accounting standards, and accounting regulations. If the company is applying the recent international standards in producing the statements, it is fine, so we can rely on the financial ratios. But if the companies, they don't apply the recent technology in the standards, so we may face challenges in understanding the ratios. And some companies, they manipulate on their statements, particularly in the less developed countries. Just to remind you with the key terms in this, the account receivable turnover, how many times we converted the account receivable into cash. Asset test, the quick ratio is measuring the liquidity. Average collection period, how long it takes to convert account receivable into cash. Book value per share, we explained it just now. Capital structure is how we use the financial, the equity and the debts. Current ratio is measuring of liquidity. Days sales in inventory, how many days it takes to convert inventory into cash. Debt ratio is relationship between debts and assets. Due bond is measuring the return on equity. Equity multipliers is a function of the debts. If the debts increase, the equity multipliers increase. Earning per share is the relationship between net income divided by the number of shares outstanding. Financial leverage, how much we are using the debts. Fixed asset turnover, it measures the utility of the fixed asset in producing sales. Inventory turnover, how many times we convert assets into cash in a particular period of time. Liquidity ratios, measuring the our ability to pay back the current liabilities. Market to book value is market value divided by the book value. Notes payable is one of the accounts belong the current liabilities. Operating return on assets It's measuring the return on assets and the efficiency of asset in generating operating income. Price earning ratio is the PE ratio, the price divided by the EBS. Return on assets, return on equity, times interest earned, how many times we cover the interest from the operating income. Total asset turnover ratios is the efficiency of asset in generating sales, and the trend analysis is a particular analysis depend on the time horizon. Okay, this is the end of this chapter. Any question? خلصنا هيك؟ Any question?
historical cost هي bar value ولا book value؟
الهيستوريكال كوست. الهيستوريكال كوست هي لها علاقه بالفيكس اسيت. فاي فيكس اسيت بتسجل في الهيستوريكال كوست. تمام؟ لا بار ولا بوك. فهي بدك تحسبيها، ممكن تحسبيها البوك فاليو. يعني مثلا book value for this machine is equal the historical value minus the depreciation. Okay, any question? Okay, so here we finish the chapter 4, and next week we'll talk about chapter 5. So prepare yourself to the chapter 5. Okay, thank you.